Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning, hello and welcome to Bazaar Morning Call. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Surabhi Upadhyay. With me as always is Nigel D'Souza. And we have Rima with us to start off this brand new week. And as we start the week off, it's a feel-good factor, lots to celebrate on the field, off the field, in the market, lots to talk about. So we'll get straight to it, guys. Good morning.
Hi, good morning. What a thriller, right, yesterday?
Absolutely. The last week has belonged to India. The Indian markets outperformed. And yesterday, the men in blue, they stood up. They took their, righteous position as the best team in the world. Champions yet again. Don't rule out my boys. I keep saying this. We had a couple of difficult months, but we came back strong. And guess what? Our captain, Rohit Sharma, says he's not done as yet. He clarified that, any kind of speculation was put to rest. And the boys doing that dance, together. That told you the kind of picture. And later on, Sunny Gavaskar as well said, I can still dance as well. So the Indian team, top of the pops, men in blue, coming out champions. I'm pumped up this morning.
Yeah, I know, even at home, the fact that there are no final sort of announcements of people walking away in the sunset, I think that's doubling the celebration, that it's not happening. Maybe just as yet. But we've got plenty to talk about as well. And I think the Indian team's fortunes in this tournament and the Indian market's fortunes are kind of coincided, because last week when we really went on that winning spree is when the market also started looking a little better, lesser FPI selling, and we'll talk about that as we get to it. But what a night, really.
Well, that's right. And the team construct is such that maybe we could possibly put in India a second team as well, and still have two teams of ours playing in the semi-final, because that's good. The next gen as well is shaping up very, very well. You have Iyer, you have Gill, all the boys in there.
Varun Chakraborty, the discovery of the series.
Amazing. And the New Zealand players came out there attacking him, and then he bounced back. So Kuldeep, all of them, splendid performance, and feeling so good this morning.
Oh, absolutely.
And not to forget, it's a truncated week, right?
How could we forget that?
So you start with a win and you end with Holi.
Which is why I said plenty to celebrate this week. Okay, let's look at the cues, and they're actually not too bad when we're looking at the global backdrop and we're looking at where India stands in that overall context. Quickly to come to Wall Street. First of all, Friday was a bit of a relief. After several days of selling, there was some green, actually not without volatility. Even on Friday, the US indices were a little all over the place. But by the end of it, they managed to recover. The gains were about 0.5% to 0.7%. Now, the jobs report was soft. Quickly to get into the internals. Non-farm payrolls up 151,000, and that's so well short of the estimates, which were around 170. The previous number was revised as well, revised downwards to 125,000, the January number. That's something to keep note of. The unemployment rate was 4.1%, estimate was around 4%, and the average hourly wages, they did rise about 0.3% month on month. They rose about 4% year on year. But that rise was also slightly lower than estimates. So overall, slightly soft jobs report. And the thing is that this is a jobs report before the DOGE-led cuts, all the layoffs that Mr. Musk has been announcing, before they kick in. They'll truly start reflecting in the March report. So the unemployment situation will be watched carefully. Now, what was the market reaction to it? Equities still managed to drift higher. Bonds were really, going nowhere, and the dollar continued to tumble. For bonds, it's a bit of a, catch-22, because while you can say the report is soft and maybe you have hopes of a, US interest rate cut, the other side is the whole tariff business and the higher inflationary pressures that are now being penciled into the US economy. So that's what kept bonds on a very tight leash. Hardly 2 to 3 basis points movement, both on the US 2-year as well as the 10-year. So we're around 4.3%, just around that handle on the US 10-year as well. The bigger move happened on the dollar. The DXY slipped. This is Friday's action. It slipped below the 104 handle as well. In fact, the dollar has been weakening against a lot of the key counterparts, the euro for sure, the yen and the Swiss franc, and we had more of that on Friday as well. The euros made the biggest headlines last week when it comes to its move. Almost 4.5% weekly rally against the dollar. I mean, those are incredible levels that we're talking about. 1.08 on the euro dollar equation. That's what we're seeing. Even this morning, as you can see, the dollar index is slipping further away from that 104 mark. So the weakness in the dollar is something that you really, can't be away from. Now, why do I say that it's a little muddled with respect to what happens with this soft NFP? Why is the market not cheering it as much? Because of this quote. Mr. Powell he was speaking at a New York event, and he came and said that we do not need to be in a hurry. We are well positioned to wait for greater clarity. And he's speaking in context of US tariffs. So right now, if you're looking at the market, the expectation is 3 rate cuts, 25 basis points rate cuts starting June. That's what the Fed Watch tool is telling you. But this comment is telling markets that the Fed is in no hurry. They're going to wait and watch to see the inflationary impact of the tariffs. Speaking of tariffs, I mean, that was really playing out on Friday. Once again, a lot of the European luxury good makers, I mean, stocks like Burberry and all, they were falling 5, 6, 7%. So that continues to be a big, big concern. And that's a concern for us as well. We'll talk about this because over the weekend, President Trump has blasted India once again about, India's role and how it's so difficult to sell anything in this country. So we'll get to that as well in a bit. The only real negative is oil because geopolitical talk is back and the all-important meetings in Saudi Arabia to try and reach a peace agreement, a ceasefire agreement on the whole, Ukraine-Russia issue. That's going to be center stage. So geopolitics is back. And in that or against that backdrop, there was another threat coming in, this time for Mr. Putin from Donald Trump saying that I will impose, greater sanctions if Putin does not get to a ceasefire. So that's something to take note of as well. Very quickly, US markets have started faltering. That's coincided with higher or lower FPI selling in India. That's the extent of price damage on Wall Street that we've seen, 2.5% to 3.5%, coincides with the fact that FPIs are selling less and less in India. Will they now relent now that the home market is having some issues? I'll just round off with the final numbers. And remember, I showed you this tally on Friday morning as well, up until Thursday. Just add Friday's number. That's a beautiful looking chart. The intensity of daily FPI selling has been coming down. If you can get more of that, it'll be fantastic. And we're just about 1% away from the 20 DMA. So the Nifty perhaps is going to take aim at that first up. But let's see how this plays out, guys.
Well, just some more points on the U.S. markets in last week's performance. The U.S. 10-year yield was up 10 basis points at 4.3%. And now the S&P 500 is below the closing level on 5th of November. That's the election day. So Trump can, the market performance is one of the key parameters Trump tracks. And now it's erased all the gains below the election level low. And the dollar index, of course, as Surabhi pointed out, lost more than about 3%. Last week for the Indian markets was a week of repair and recovery. The market snapped a 3-week losing streak. On the Nifty, we were up 1.8%. The mid-cap index up 2.5%. Small-cap index rallying 5.5%. The Nifty logging its biggest weekly gain in nearly 3 months. In terms of flows, the FI selling intensity has been coming down. On Friday, the DIs bought 2,300 crore, while the FI net sell was nearly 2,000 crore. So the trend has shifted in favor of the bulls. The question is, will the momentum continue? Will the pullback continue? Over the last 3 trading sessions, as the screen will tell you, that the markets have been making higher highs and higher lows, and that is always a positive sign. So the important support to track will be Friday's intraday low of 22,464, and on the way up, the 20-day exponential moving average, which is about 22,700. So 22,700 to 22,800 is seen as an important resistance. Quick, the cues to track this week. One, it's a holiday shortened week on account of the holy holiday on Friday. We've got the US inflation print on 12th. Back home, the India macro indicators include February CPI and the January IIP. And then you'll watch, for all the ongoing tariff negotiations, the updates, geopolitical tensions, the impact on dollar and crude.
Well, that's right. The weak US data is something that will not worry me, at least as of now, because it's calling the dollar index to a slip. And also it's making the mood more conducive for a Fed rate cut. And on the domestic front, a couple of positives. One is with regard to the RBI injecting liquidity. And the second factor is the FM talking about rationalization of GST rates. Both those two are in the line of growth, and the markets want growth, right? So the economy seems to be in pretty okay shape. And now these moves as well will further make the case that in the coming months things will look better. Let's take stock, though. The Troika, so to call it, well, they're in favor of the Indian markets because the dollar index is weaker, Brent crude price is well behaved, and the US yields as well, more or less flattish. Moving to the India's outperformance in the last week, that's great, right? After a while, we outperform. But in the last 1 year or so, actually, India's been a rank underperformer. If you compare us with the US markets, the Dow is up close to around 10%. The NASDAQ, as well as the S&P 500, they're up between 12 to around 13%. So, it gives us some kind of cushion because we've already underperformed. So it gives us a better case to outperform from here on because valuations as well have become far more palatable in comparison to what it was a month or so ago. What do the FIs do? Well, they're selling relatively less in the cash market, which is great news. That net sell numbers come down by half. And they continue to add mild shorts. So their short positioning now is sub 82%. Remember the start of last week, it was close to around 85%. So the FIs, well, they continue to remain net short, close to 1.85 lakh contracts on the short side, while you have clients that they are net long now. So both of them, as has been the case, they have been on opposite ends of the spectrum. FI is close to around 1.8 lakh contracts, clients 1.4 lakh contracts on the long side while they are on the short side. Pulling up two strikes that are fairly active, the 22,800 call and the 22,300 put. Both of them were fairly active in Friday's trading session, and that gives you the broad levels. The Nifty had a good week. You'll get more confident once the Nifty can get past its 20 DMA, which is important, 22,750. On the Nifty Bank, the 49,000. So both those two, they become the important resistance levels from a bullish perspective. So you want to keep an eye out on that. And the reference points you have, going by the options data, the 22,250 mark becomes important that it gets some kind of support at that level. While on the Nifty Bank, we went to this level of around 48,200 in the past week and we bounced off that. I'm looking at two stocks. One is IndusInd Bank because it's been a relative underperformer, and now you have news that the top boss out there has got an extension only of around a year or so. But there was some on the street that was speculating maybe that extension doesn't come about. So IndusInd Bank will be one stock I'll be looking at. And as I said, it's already down more than 10% in the last 1 month itself. It's underperformed what the Nifty Bank has done. And there are shorts in the system as well. So if it opens up weak, I'll be interested to see whether or not it sees a bit of a bounce from the low point of the day. So that's one stock that I'll be looking at. And the second one is Reliance Industries. Equirus is the last brokerage to go ahead and upgrade the stock. Remember, in Friday's trading session, it conquered that 20 DMA, which is an important technical mark. And it's suddenly taken on the mantle of fighting for the bulls. So this one needs to continue its good form.
Absolutely, and the bulls will hope they can continue their good form from last week as well. Let's get started then. There's the equity call coming in this morning. It's actually a little positive one as well. Sunil Kaul of Goldman Sachs says that the cyclical slowdown in India's economic growth and profits led them to downgrade their view on Indian equities from overweight to market weight about 5 months ago in October. He says with the Nifty now down 16% in local and 19% in US dollar terms from the late September peak, investors are focused on whether it is time to accumulate. He adds that while the worst seems to be behind us in terms of economic growth and earnings trajectory, as well as prices have corrected meaningfully, he expects a gradual recovery in growth. He thinks market volatility could remain high near term, given still elevated domestic positioning in small and mid caps and lingering global uncertainty, especially with respect to reciprocal tariffs that could potentially significantly impact India if implemented.
Well, let's get some views then on the global markets. Bhaskar Lakshmi Narayan, Chief Investment Officer and Head of Investment Management Asia, Julius Baer, is now with us on the show. Thank you very much for joining in. So first, give us the emerging market setup. The mojo has been back in the Chinese markets, Hang Seng, since the start of the year. Even the NPC emphasized China tech, AI innovation. But back home in India too, after a rough 5 months, last week at least, the risk sentiment seems to have improved. So what's the, give us the top-down view on emerging market and then break it up country by country.
Well, I think it's going to be a slightly positive year for emerging markets. I wouldn't go as to say it's a very bullish turn of events. One shouldn't take the fact that there is a correction in the US markets to be a positive sign for the rest of the world at this point. In fact, if anything, if the US or the global markets driven by the US starts to drop a bit more, I think that sentiment will sort of pervade all other markets too. So one should be cautious about how one plays this. In terms of emerging markets itself, I think China obviously is in the sweet spot at this point in time. You've got valuations that are very attractive. You've got policy making that's very supportive. And you've got a lot of the bad news behind you, especially when it comes to real estate, which is possibly their real big problem to solve. So I think they're coming to the end of that real estate solving. And if that happens, then you see a further upside. But I would say in a relative sense, yes, China looks a lot more attractive than any other emerging market.
Oh, okay. That's quite an interesting take, Ms. Lakshmi Narayan, because we're always competing, right? So if the US is doing well, then it's a problem for us. Now, like you're saying, I get that point, that if the US is not doing well, then it's anyway a problem for everyone. And then there's China, which is looking good to you, like you're saying. So where is India sort of in this whole mix? How are we stacking up, given this 16, 17% correction at the headline index level and much more in the broader market?
Look, I've always been, and we've as a house been very favorable towards the large caps. And I think now, especially with the correction, I think the large caps are looking quite even better, if anything, right? It's the problem really is, I think, in the small cap, maybe at the bottom end of the mid cap segment, which I think still needs some sort of a reset, despite the correction. So when we look at any market, we look at three things, right? We look at obviously the returns that you want to achieve, and then you look at volatility, and most importantly, liquidity. Now, if we've seen the first couple of factors play out as far as the small cap is concerned, it's the liquidity part, I think, will finally play out at some point when nobody wants this segment or more people want to exit than people want to buy this. And I think that's going to be the last leg in the small cap, mid cap space.
Hi, sir. Good morning and good to see you. When I recall when we chatted the last time around, you briefly mentioned there's a possibility the Fed doesn't cut rates by that much, going ahead. And that seems to be what the street as well is coming to terms with in 2025. What are you working with in terms of the Fed action for the remainder of this year? Some say that maybe, in fact, we don't see a cut, while recent soft data points point to the direction that maybe we'll get 25 or 50 basis points. What are you factoring in? And also on the RBI, we've got one rate cut. Out here, the hope is that we get another one in April. Are you in that camp?
So we've always been below the market consensus for the last, I would say, a year plus or more. We've always been behind in terms of expectations on rate cuts. We are of the firm belief that the US is more prone to an inflation risk than to anything else. You could have a policy mistake, you could have a supply chain constraint. This whole tariff talk is a lot of noise, but noise can create some amount of inflation too. So all of those things, I think, mean it's very difficult to have a very, very positive outlook on rate cuts. It's easier to say, stay where you are, and things get really bad. You could even have a rate hike, right? But we're not in that camp. I'm just saying that. So I think betting too much on rate cuts is possibly not the ideal thing to do, which also means that the dollar differential or the rate differential somewhere along the line is going to start again playing in favor of the dollar. So while you're seeing some weakness now, I wouldn't bet on a very prolonged weakness in the dollar.
Okay, all right. That'll be an interesting thing to watch, because it's been whipsawing all over the place between highs of 110, now 104, below 104 actually. So it's been very, very choppy along with many other markets. Thank you very much for the quick view. Much appreciated. Thanks for joining in today.
Thank you. Thank you so much.
All right, so that's a quick update on how the globe is looking. Let's now tell you more about what's lined up on the show today. Lots of interactions as always at 8:35. We will be speaking with the management of Astra Microwave. A lot of defense stocks have cooled off significantly from the top. So what lies ahead and what are the specifics for Astra as I look forward to the new fiscal year? We, at 9 a.m., will be in conversation with Jinesh Joshi of Prabhudas Leeladhar. We'll talk about the recent rally in media stocks and how the sector is looking. Pankaj Murarka of Renaissance Investment Managers is our market master of the day, so he comes in at about 9:20. At 9:30, we speak with the management of Vinati Organics. The company is, of course, quite exposed to the US. It's also incorporated a wholly owned subsidiary, Vinati Organics USA. So how is the whole US picture shaping up and how are they mitigating some of the risks over there? After that, we have Vajeesh Sivakumar of GE Shipping joining in, talk about how global charter rates and tanker rates are being impacted with this tariff talk, demand supply in the shipping markets. At 9:50, Boman Rustam Irani of Keystone Realtors joins in. With the stock market cooling off, is there some sort of a follow-through effect on real estate? We'll ask Boman as we go forward. And finally, in our special series Market Masters, Lata today will be in conversation with veteran investor Devina Mehra.
All right, time to slip into a short break, but we've got a lot of stock-specific action to track for you in our special Top 10 segment. For the time being, the list comes up for you on the screen. Sun Pharma, JSW Steel, Shah Metallics, IRB Infra, RailTel, Lupin, Biocon, JB Chemicals, all of them will be reacting to positive news flow, while on the flip side, you have IndusInd Bank and Olympic Pharma that will be reacting to negative news flow. Slip into that break, come back, we'll get into further detail on all of these names.
Welcome back. You're watching Bazaar Morning Call. It's a Monday morning. The cues from Wall Street on Friday were positive. Key indices ending with a gain of close to about 0.5%. The question is, will the pullback continue in the Indian market? Last week, we rallied close to about 2 to 2.5% on the large caps and mid caps. But let's drill it down to individual stocks now. Our research team is standing by with CNBC-TV18's list of top stocks for the day. First up, it's Pharma Dose. Vinny's joining in on Sun Pharma.
Good morning. So Sun Pharma, just this morning we have this news flow coming in where Sun Pharma is going to be acquiring Checkpoint Therapeutics, which is a US listed company. This is mainly into immunotherapy as well as targeted oncology company. So mainly this is going to be a good addition overall to Sun Pharma's specialty portfolio. This will bolster the innovation portfolio, especially in oncoderma therapies for Sun Pharma in the US market and globally as well, the global presence. Now overall, this company also has an important drug approval from the US FDA. This is for Unloxcyte, which is a drug which is used for treatment of, an PD-L1 treatment for CSCC, which is some sort of a skin cancer kind of treatments. So this is the only one which has gotten an approval so far. So an important drug that will get added, and they will be launching these products as well. So yes, an important transaction there. Overall, upfront cash what Sun Pharma will be paying will be around $4.1 per share, and this will aggregate to around $355 million. Other than that, stakeholders will also receive contingent value right of up to $0.70 per share. Other than that, Checkpoint will also, the controlling stakeholder Checkpoint will have a royalty agreement. So Sun Pharma may be paying some royalty over there as well. That detail is not exactly given, but there is a royalty agreement that is signed. Sun Pharma expected to open in the green because this is a positive sign coming in terms of the specialty portfolio. Good addition there.
Okay, all right, got it. So positive news for the stock. Vinny, thank you very much for that. Let's get to Abhishek. Abhishek, so it seems that Mr. Sumant Katpalia is getting an extension, but not as long as what IndusInd Bank had asked for?
Not IndusInd Bank. The board has actually sought for a 3-year extension. So IndusInd Bank's MD, that is Mr. Sumant Katpalia, for a second time in a row gets a lower tenure than what the board had sought with the regulator, that is RBI. So he's now got a 1-year extension up to March 26 to be the MD and CEO of the bank as versus 3 years that was sought by the board. So last time RBI had again, given just 2 years extension versus 3 years that was sought by the board, which means that RBI might be not comfortable with giving a complete 3-year tenure to Mr. Sumant Katpalia. Now, our analysts say that this means that the board will have to find a replacement. This creates a leadership uncertainty in the interim period. Now, previous similar instances were seen with other lenders as well, like RBL Bank, they got a 1-year extension. Bandhan Bank, they got a 3-year extension versus 5-year extension that they had sought. Federal Bank had sought 1-year extension, but nothing was given to them. So, there have been previous instances wherein RBI had not been comfortable with respect to the tenure that, the board of the respective banks have sought. Weak profitability as per, IFL securities in FY26, coupled with leadership uncertainty, should keep the stock price under pressure. So brokerages, largely most of them have cut, the target price on the stock. Citi has a buy recommendation, Jefferies buy recommendation, MK buy recommendation, but BofA has actually downgraded the stock to underperform and cut the target price as well. IFL Securities also has a buy, but they have cut the target price on IndusInd Bank. Back to you.
Thanks a lot for that, Abhishek. We'll keep an eye out on that one. It starts off in the red, and let's see, because there are a lot of shorts in the system as well, whether or not there is some kind of covering. The stock in the last 1 month down 13%. Let's focus on a couple of metal stocks, though. JSW Steel, well, they came out with their numbers for February. Normally not a big market mover. Production number has spiked up close to around 12%. Remember, they have production that's coming on stream and expansion that's coming on stream. So that's on expected lines that you see a bump up there. And also, if you look at the capacity utilization level, particularly for the India operations, it's hovering in the vicinity of around 93.5% odd. Demand on ground should be pretty okay. And we're getting into the seasonally strongest period, which is towards the end of the year. So going with a mild tinge of green on that one. The next one, we're looking at Shyam Metallics. The stock saw a big bounce in Friday's trading session, and they have given their February numbers as well. Keep in mind, February of this year had one less day in comparison to February of last year. In comparison to January, obviously, it's 3 days lower. Stainless steel as well as aluminium foil, both of them are relatively newer segments. On a low base, there's a good bounce out there. Specialty alloys is more or less flattish, while carbon steel, sponge as well as pellet, there's a bit of a downtick out there. So you keep an eye out on that because some part of that could be used captively as well. But going with green out here as well, because on a sequential basis or on a month-on-month basis as well, they have given that pricing is gradually improving. And also there is hope that there'll be some kind of duties that will come in there to protect the domestic ferrous industry. So tinge of green on both JSW Steel as well as Shyam Metallics. But let's go back to Vinny. She's here to tell us about Lupin as well as Biocon. Vinny?
Yes, so both Lupin and Biocon, some positive news coming in for both these companies. Now, Lupin, firstly, let's talk about that one. They've announced the launch of a generic drug. This came in Friday late evening, and this is the drug that is Rivaroxaban. 2.5 mg tablets. They will be launching this in the US. Now, this is to reduce, this drug is mainly used to reduce, some cardiovascular events in patients who have coronary artery disease or even for patients who have peripheral artery disease. Now, this is an at-risk launch that is coming in from Lupin. The patent is going to be expiring in 2039. There's already Sun Pharma also who is filed, for this litigation. They are also waiting for some approvals coming in from US FDA. So there could be some competition that will also be launching in. But obviously what Citi believes that this is a $446 million brand and this may contribute around 7 to 10 million per quarter for Lupin as well as any other company that launches if it's a two-player market. So interesting to watch out for this one. As of now, surely we could see an up move coming in for Lupin. Biocon also green because they've received some positive results of phase 3 trials that they're done for ustekinumab, which they've been working on as a biosimilar. Now ustekinumab, do not forget, is around a $6,966 million market in the US and around a $3,900 million market ex-US also. But there are already competition which have released, and launched this product or have gotten an approval from the US FDA. This is the US market. There are 4 players currently who have launched or have received an approval. So there is already competition, but still positive results is a positive sign for Biocon.
Thank you very much for that. It's over to Hormus now for the latest on IRB Infra and RailTel.
Positive developments coming in from both of them. IRB Infra came out with its toll collection updates over the weekend. It's gone up by 18% to almost 530 crores. The management also is saying that they are now very confident that they will surpass the toll collection revenue of FY24 this year and that the further budgetary allocations will also provide more impetus to toll collections going forward as well. So expect that stock to open in the green. And RailTel as well. It's won 2 orders, one of which is from East Central Railway. That's worth 47.5 crore. That is for the design, manufacturing and supply of electronic interlocking systems in Dhanbad, and the other one is for 28 crore order for indoor and outdoor double distance signaling work, and that is supposed to be completed by September of 2026. It's won plenty of orders in the recent times. Expect the stock to open in the green as well.
All right, and let's get the hat trick complete with Vinny. Vinny is like really dominating the list today, right? Lots of pharma stocks in news. Which are the other ones, Vinny?
Absolutely. A lot of pharma companies, announced news flows over the weekend. Alembic Pharma is the other one. We're expecting a bit of a red here. Now, why? Because US FDA has completed an inspection in its bioequivalence facility. This is in Vadodara. Form 483 has come. One observation. This is a procedural observation. This inspection was somewhere between 3rd of March to 7th of March. But just one procedural observation is what they've received. So yes, some bit of an impact is what we could see. A red or a muted start is what we're watching out for. Not a sharp decline for Alembic Pharma, at least is what one could watch out for. JB Chemical Pharma, that's also one which we're keeping an eye out on. Now, the company's formulation manufacturing facility in Gujarat was also inspected by the US FDA. No observations received for this one, no Form 483. So yes, positive one for the company, and we're expecting green.
Thanks a lot for that, Vinny. Well, let's do a quick recap then of all the top stocks we just discussed. The ones with positive news flow: Sun Pharma, JSW Steel, Shyam Metallics, IRB Infra, RailTel, Lupin, Biocon, as well as JB Chemicals. All of them will be reacting to positive news flow. While on the negative side, Evident Bank and Alembic Pharma that will be reacting to negative news flow. That's about the equity markets. But let's turn our attention to the commodity space. Manisha Gupta joins in to fill us in with what's going on there. Morning, Manisha.
Morning, Nigel. Thank you for that. I'll start with the crude oil prices, where we have seen the prices ease yet again. Remember, it's been last 7 weeks. Every week, the crude prices have continued to decline. There is this shifting trade policies from U.S. that has raised a lot of uncertainty on economic growth and energy demand as well. And the markets are looking at higher supplies going forward as well. That's weighing onto the market. Also, when you look at the U.S. jobs data that came in on Friday, wasn't really supportive, and that has led to the U.S. dollar index now trading at a 4-week lows and a fourth week of decline on that one as well. And that's now weighing onto the metal prices. For last 2 weeks, we've seen many of these metals actually do quite well, whether it has been about copper, which went to a 9-month highs, or zinc, aluminum, steel. Rather, the China steel restructuring statement also led to some support. But today in Asia, what you're looking at in sense of metals is profit taking across. So 0.25% to 0.7% of a decline coming in across metals there.
Okay, all right, Manisha, thanks very much for a quick roundup. We'll come back for more to you in some time. Right now, I have to take a very quick break. On the other side, we'll have Prakash Diwan join in, talk about a couple of the stocks that have been in news over the weekend and get some more new investment ideas.
Welcome back. Hope you're having a good morning. Prakash Diwan joins us as promised to help us out with some analysis on all the stocks we just discussed. Hi, Prakash. Good morning. Good to see you in. Prakash, let's talk about IndusInd Bank. You know, that was a big underperformer, not just in Friday's trading session, but in the last 1 month or so. Now you have the news that their top boss hasn't got an extension for 3 years, but he's got an extension for around 1 year, with some believe that will be adequate to find a replacement. And also in the past, we have seen whether it's RBL Bank, Federal Bank, Bandhan Bank, when they didn't get the desired extension in comparison to what the board had asked for, the stocks reacted negatively, but in the following month or so, they did see some kind of recovery. How would you approach IndusInd Bank if it starts off in the red?
Good morning, Nigel. So I think I do agree, the development is not as anticipated, or probably is short of the anticipated outcome. But it's at the same time positive enough that he's not been, not given an extension, right? So in that sense, the bank gets time to find the right candidate. It could be, enough time for them to even look externally, since internally they probably don't yet have set sights on anybody to fill that gap. But, the shorts that are in the system, IndusInd is down about, 9, 10, 11% as compared to the Nifty. It's underperformed. There could be a case of, a bit of short covering that can happen because of the other development that's likely, and which is there's some life insurance business that's probably looking at buying into it. There's some news about it. I don't know whether that's confirmed. But if that were to kind of play out, that becomes a positive, because from a valuation perspective, it does give you that comfort. But it's not a long-term recommendation, because I've always found their portfolio to be the last to get repaired once things look up. So I would still go with a Kotak or with an ICICI at this point in time rather than IndusInd. But I think the short covering could probably be slightly different this time. And, it doesn't make sense to go short on it at this point.
Prakash, morning. Reliance Industries was the stock of last week. 4 days of gains, and big gains over the last 4 days. Now at current levels, do you think there is more upside? Because investors are all waiting for those triggers around geo-listing, etc.
Very much so. We spoke about this on Friday, when I think it was Jeffries that came out with that call, and very clearly there is anticipation that Reliance will be reaching its fair value, or probably it's undervalued in some context, given so many optionalities that are kind of coming close to fruition. So geo-listing is one thing that you mentioned. Look at how retail has been expanding and becoming much more efficient. I wouldn't be surprised if this quarter the retail numbers probably beat, the segment as a whole, the sector as a whole, very, very sharply. And, refining margins have also been fairly steady and on the upward listing side. The arbitrage is far stronger for them. So, and then you have this green energy outcome that could kind of be absolutely very close to maybe the AGM is the time where you'll probably see some big bang announcements related to that. And that's just about 3 months away. So from that perspective, it does give you a comfort that if things look up, Reliance could probably risk. And remember, the ETF outflows is what has been responsible for Reliance's downfall on the stock. Otherwise, I don't think there's been a performance issue that has led to this re-rating. So if that money were to come back, and I don't know when that happens, it would only kind of accelerate things. So you're sitting in a very good risk reward from that perspective. But you'll have to have a slightly longish horizon for these things to pan out. At least, a couple of years is where, things would start looking very different for Reliance. But yes, the level at the current levels are definitely very attractive for anybody to take some exposure.
Got that. Prakash, hi, morning. Great to have you on as always. I don't know if you managed to take a look at some weekend updates. It seems that Hyundai has some 7 resolutions they need to pass. And I think some of them are related party transactions. And there seems to be some difference between how these proxy firms are looking at these transactions. One is in favor, I think IIAS, and the other SES is, I think, against. I don't know, I mean, whether you got into the nitty-gritties of this or not. But overall thoughts, Hyundai?
Good morning, Surbhi. So I did kind of catch the headlines, but I didn't really go deeper into it. The match was too much of a worthy distraction to do all that. But I can tell you one thing, some of these chaebols, the Korean firms, the way they operate globally, there's a very different, way as compared to what you would expect a large listed entity to behave. And it takes time for them to kind of reset in terms of those expectations. There's a way of working which, it's not kind of, I know it's not the right way to explain it, but at times it can be not too fair to minority shareholders. But in this case, I don't know whether, at 1700 it even offers value. Even if this were not to be there, there's no point looking at the stock because it was overpriced in the IPO. And it will continue to struggle to cross that level. And there'll be a lot of supply as it comes through. So I have never been very interested on the buy side. In fact, this could only put more pressure and make you wait longer if you actually ended up buying it in the IPO or post the IPO. So it's not something which is very favored. And I'm sure some of these things only kind of make the doubts deeper. So I would definitely look at it as an avoid at this point in time.
Okay, all right. Request you to stay with us, Prakash. We just want to focus on the defense theme because that space has seen a sharp correction. So let's invite our first management on the show. We have Astra Microwave. The stock has seen some correction this year. It's down close to around 15%. How's the second half of the year looking? What's the order book looking like? And how is business shaping up from here on? We're joined by Mr. Atim Khabra, the Director of Business Development and Strategy at Astra Microwave Products, who joins us. Hi, Mr. Khabra. Good morning and always good to see you in. Well, tell us, how's the order inflow? How's it looking? If you could tell us, what is the pace on ground? And I think earlier you were talking about an order inflow target of close to around 1,200 crores for FY25. You could correct me on that number. And also, how is FY26 looking in terms of an order inflow? Please go ahead.
Hi, good morning, and it's good to be back as always. I think we have only good things to report as what we had always told you. We are maintaining our guidance. Our order book forecasts have more or less been translated into actuals at this point in time. We are looking, delivery is on schedule, and we will cross, in all likelihood, 1,000 odd crores, which we had spoken about, indicated to you. The next year guidance has been and our consolidated order book right now is around 2,332 odd crores, and a standalone is about 1,960. And our forecast for the next year is the new order inflow is in excess of 1,250, 1,300 crores to be coming in next year, of which about 900 odd crores should translate into sales from the existing order book, plus incremental 250, 300 crores from the new orders, resulting in a guidance of about, I believe the management has come in and given a guidance of 1,200 to 1,300 crores on the next year, which is about 25 odd percent is the top line growth which we are projecting. So
Khabra,
we are preparing for a, sorry?
Mr. Khabra, just to get the revenue number out of the picture, this year you end closer to around 1,000 crores is what you're telling us?
We'll
for the next year,
as per guidance.
Yeah. And next year it'll be closer to 1,250 to 1,300 crores. Is that correct?
1,200 to 1,300 is the range which has been disclosed or guided. Yeah.
All right. The fear is
We are
about a
basically
slowdown.
preparing. Yeah, we are just basically preparing, as we had discussed, for FY27 second half onwards, wherein a lot of our order books really starts translating into regular production orders, and that should be a nice one at that time. Sorry, go ahead, please.
Mr. Kabra, just clarifying in this guidance that you've just given out on the order book and top line, you're saying should see 25% growth. Are you factoring in a large overseas contract? Because when we sort of spoke to you last, or when we last had some interactions, there was some talk about a big contract shaping up, but at that point in time, you couldn't give us too many details. So has anything moved on it? If you could give us some more contours.
We try and give guidance on the basis of actual orders on hand. That's been our philosophy. And all our extra initiatives bring in the X factor. So, we have multiple projects, multiple discussions, which are on an ongoing basis. And in fact, I would like to mention that the new opportunities for the whole industry, where you started by speaking about the industry, there is a mega trend in the offing at this point in time. If you look at the next 6-7 years, which is rearmament of Europe, they have decades have happened in weeks, and I think there is a substantial business flow which can accrue to Indian companies. It's too early to say what exactly is the quantum, but we are hearing about all sorts of numbers. Depends on what is the incremental GDP allocation which European companies
right now, sir, do you export? That's an excellent plumb point. Glad you brought it up, because it is a seminal shift, which we haven't heard of in decades. But do you have any exposure to Europe right now, or is it? I mean, thematically, yes, obviously, great opportunity. But I don't know if right now Indian companies, including Astra, whether they're geared to the kind of specifications, etc. If there are some contracts that you're already executing for, say, the French or the Germans.
We have a lot of ongoing relationships with a lot of European companies with whom we have worked in India. So there are two angles, I think, which need to be explored on this particular mega trend. One, either do you supply directly onto them, which is a slightly, again, a rear-ended kind of a thing. As orders, allocations are finalized, what exactly needs to be done is finalized. But one thing which will be very clear is that the European companies will have their hands full with their current order books. So supply chain resilience for Indian companies, and in the context of tech-based warfare, becomes a very, very critical thing, which will open up a very significant opportunity for the sector as a whole. And we will be there.
But as of now, do you export to Europe as of now?
No, nothing significant.
Okay, so you're looking at it as...
So it's all delta. It's all delta, which will come in, incremental.
Got that. Out of time, Mr. Kabra, but thank you very much for joining in and laying out the guidance for this year and FY26 and the potential tailwind from Europe increasing its defense spend. Get into a break, but as we do that, here is a quick note for all our viewers. What does it take to move the needle on gender parity? The biggest names in business, policy, leadership come together at the Mega Summit for HSBC presents CNBC-TV18 Future Female Forward, co-presented by Cognizant. To answer that, tune in live on CNBC-TV18 today, 5:30 p.m. We bring you insight from those shaping the future. Welcome back. Let's find out the trade setup for today's trade. Sudarshan Sukhani, Mitesh Thakkar are now with us on the show. Gentlemen, good morning. That's the question, right? Does the uptrend sustain from current levels? Is there more steam, or are we likely to see renewed pressure, selling pressure at higher levels? So Sudarshan, you go first. What's the trade on the indices, and how do you expect today and the coming few days to pan out?
Yeah, good morning. Well, last week was excellent. In this program, we caught the lows and went long almost when the market rally started. Now, this cannot continue. We all understand that markets go through cycles of volatility and, say, contraction. We saw a very decent expansion last week. And this week, we also have the the truncated week. Friday is a holiday. So I would think that this is a period when we'll see consolidation rather than a new big rally. The consolidation would mean that markets could be choppy. Since the short-term trend is up, sharp dips should be used to buy. There's no rush. If in the unlikely event of a breakout, we'll just have to let it be till we get a dip. So the trade still is wait for sharp dips and go long, but don't run and chase a breakout.
Okay, got it. Don't be in a rush. Last week, as Sudarshan said, that they had said that buy into the dip and look forward to some gains, which have taken place. Now, in fact, just wait in there, look to buy sharp dips. Let's go across to Mitesh. Mitesh, what about you? How are you feeling about the markets after a while? We had the opportunity to say that India outperformed in a week after underperforming for multiple weeks. What's your take? How do you trade from here on? For the time being, the GIFT 50 suggesting an 80-point pullback.
Good morning, Nigel. So I think, we also maintain that the immediate or the short-term trend is on the upside. If you look at the last few days of movement, the Nifty moved up from sub 22,000 levels to about 22,600. And maybe, it's gained about 650 odd points. So it will give away about 150, 200 points. But my sense is that unless until we break this 22,400, 350 zone, I think declines closer to that level would be entry point on the long side. So to me, I think around 22,400, 420 is where I would want to buy. And I believe that 22,600 should be the first target, which is where we also, had the highs on Friday. And once we cross that, 22,770, 800 broadly is the zone where I think the Nifty will eventually go. I'm not sure of move beyond that, but in the short term, I believe that we are very likely to test this levels of 22,770, 800. So with that, I think the view or the bias is on the upside.
Let's get to some stock-specific ideas then, Mitesh.
Yeah. So I have more of buy calls in line with my market outlook. So a buy on Berger Paints with a stop at 4 targets of 535. Here I would recommend a stop below levels of 502. Buy on LIC Housing Finance with a stop at 522 for targets of 550. Voltas is a conditional buy if it starts getting past 1420. Buy with a stop around 1400 for targets of 1465. And one sell call, that's Oracle Finance. Keep a stop at 7680. Look for targets of around 7390 on the downside.
Okay, all right. Got that, Mitesh. Let's go back to Sudarshan. Sudarshan, take your point that one doesn't need to get carried away with the market recovery too quickly. But what about stocks? Individual action today?
I think the individual action should be mainly on the long side of the market. So I have an all buy list. Enfin Homes is a buying opportunity. Enfin Homes buy with a top under 617. Apollo Tyres is a buy. In fact, if you see Apollo Tyres charts, it's been in a consistent uptrend even when the Nifty was falling. That's interesting. Consider buying Apollo Tyres with a stop under 402. Glenmark is a buying opportunity. It's been an outperformer. Buy Glenmark with a stop under 1373. And finally, Bharat Forge is a buy. Now, this is a rather speculative buy because it depends so much on news, but it's worth finding out whether it has a big move coming. Have a stop under 1,069. But for all the stocks we have discussed, follow your stop losses.
Got it. Thanks a lot for that, gentlemen. We'll come back to you all for the 9-10 callers as well. For the time being, we slip into a short break. On the other side, we have Jinesh Joshi or Prabhudas Liladhar. He is joining in to tell us about the recent rally in the media stocks. Stay tuned for that conversation.
Okay, we're just about hitting 9 a.m. So we'll get the pre-opening rates in a bit. Asia is a lot more mixed this morning. One point that we didn't mention, should speak about it right now, is that the inflation numbers that came out of China on over the weekend, they are talking about disinflation. Inflation's fallen quite substantially in China. So that whole pressure, and we've seen that the Chinese have acknowledged it. They've revised downwards their inflation projections as well for the next year, while saying growth will be 5%. But that's really weighing on markets today. Look at the price cool-off on the Hang Seng, and on the mainland Chinese markets as well. Taiwan's down, but Japan's doing well, so it's very mixed. Implied open, let's see what all of this means for us. The indication is that we could start slightly negative because of this Asian opening, but the hope is that then the buyers will come in and maybe we'll see the Nifty make an attempt, who knows, cruise towards the 20 DMA as well. Anyway, since we're talking about global issues, the one thing that really is a sticking issue, like we mentioned in terms of cues, FPI selling has come down, that's good. US markets recovered on Friday, that's good. The dollar is falling, that's good. One thing that's not good is this constant back and forth on tariffs. And we had President Trump come out with the big criticism once again for India, saying there are high tariff barriers in India and it's extremely difficult to sell anything in India. Listen in.
India charges us massive tariffs, massive. You can't even sell anything into India. It's almost restrictive. It is restrictive. You know, we do very little business inside. They've agreed, by the way, they want to cut their tariffs way down now because somebody's finally exposing them for what they've done.
And couple this with what the US Commerce Secretary, Mr. Lutnick, Howard Lutnick, said on, I think it was a CNBC program over the weekend. He said everybody has to make in India. Why are they making these iPhones out in China? Or maybe now in India as well, right? They need to make these iPhones here in India. And if there is a cost, it's not a problem because robots can make those phones in the US. All kinds of things being said. But on a more serious note, this is a big issue that we still have to navigate. We are now learning from sources that, of course, those India-US talks have been progressing. We know our Commerce Secretary was in the US all through last week. So where do things stand now? We've got Parikshit joining in. He's been keeping his ear close to the ground. This is the big one, Parikshit. What's the sense you're getting as of now?
Well, yes. Donald Trump there on Friday making it clear in a statement that India has agreed to reduce tariffs significantly, and he said that it's very impossible to sell anything in India. So clearly it seems that the US government, through public statements, was putting a lot of pressure on the Indian government to reduce tariffs. Just last week, Commerce Minister Piyush Goyal was in the US for talks with Howard Lutnick, the US Commerce Secretary, and Jamieson Greer, the USTR. The sense that we are getting from our sources that India may be looking and considering reducing the average applied tariffs. So, for example, if the average applied tariffs by the US is 2.5%, India's average applied tariffs in the range of 9 to 12%. So there is some negotiation going on to reduce the average applied rate, which is the average rate across product lines. Interestingly, Howard Lutnick had told a TV channel last week that we're not looking at a product-by-product deal with India. We're looking at a broad macro-level deal which overall brings down tariffs. So this could be 0 for 0. This could be average applied tariffs. That remains to be seen. But India has said that in previous FTAs with Norway, with UAE, with Australia, we have brought down the average applied rate significantly, and negotiations with the US should be seen in that context.
Okay, all right, Parikshit, thanks very much. Well, the last word still hasn't been said on this. We still need to get more clarity on what this overall deal will look like for India from our perspective. Thank you very much for that. Let's take this to Prakash. Prakash, there are still lots of Indian companies that have exposure, right? Lots of exporters. And I'm not only talking about areas like textile, which is obvious, but lots of pharma companies, lots of chemical companies. We'll be speaking to one in a bit, Vinati Organics. They're, for instance, now setting up a new subsidiary in the US because of all this pressure that's out there. Any specific advice on 1 or 2 or 3 stocks or companies where maybe you'd take your foot off the pedal a little bit because of potential tariff hit? There are automakers as well, I forgot. Yeah, a lot of auto ancillaries also are suppliers to the US.
Yeah, absolutely. So, the list of what you could avoid is far longer because of the uncertainty and the broad potential range of where tariffs could impact us. Because it's still work in progress. We really haven't seen the last of it. But I would invert a bit and look at what's looking positive, and that's the pocket you need to go and fish into. So, for example, the way you mentioned Vinati, there are companies like Welspun Corp, which already have a running unit. They've been supplying from there. They've been producing from there. And, even if tariffs were to get imposed, which could happen to any segment, any sector, these are the companies that would be much more resilient to this entire tariff tantrum. So I would look at some of those names, and then they also have domestic tailwinds, Surabhi. So, it's a very good combination to look at some of those names. But I think it's still very amoebic, very fluid at this point in time, which tariffs are going to impact and to what extent. So let's wait for that. But yeah, given the situation on the ground, some of these companies like Welspun, as I said, just case in point, is definitely looking very positive.
Prakash, thank you very much for joining in. Interestingly, Innocent Bank has been flip-flopping between the red and green. It was down nearly 8-9% in pre-open. It went back in the green, up nearly 1%. Now it's down 1%. So just trying to, find its rate in early trade. While the news is negative that Sumant Katpalia has only got a one-year extension after a 40% correction from the peak. Is all the bad news priced in? That's the debate that's raging right now. But let's focus on the media and the entertainment stocks. So last week, the Nifty Media Index saw a near 7% rally with names like Z Entertainment seeing a double-digit up move. Jinesh Joshi, research analyst at Prabhudas Leeladhar, is now with us with his call on the sector. Jinesh, let's start with Z Entertainment. Promoters bought a bit, so that infused confidence, plus valuations are seemingly attractive. Give us your view on Z Entertainment.
Yes, promoter buying is a soft signal that things are on the improvement scale. So if you look at their last quarter numbers, I think the EBITDA margin at 16% was definitely good, taking into consideration that the ADEX spend has been slightly weaker. Also, if you look at their digital business, I think the EBITDA loss in Z5 at about, 135 to 136 crores was perhaps at multi-quarter lows. So definitely valuations are attractive at these levels. The stock is at about 9 times FY26 EPS. But I think for one to turn really constructive on this name, we'll have to see how the recovery in the ad environment happens. So if my memory serves me right, from 2Q of FY23, we have seen Z's domestic ad revenue decline barring one quarter. So I think one should ideally wait for an improvement on the ad environment side. And if that happens, it can be an icing on the cake for sure.
All right. Hi, Jinesh. Good to see you. But Jinesh, valuation-wise, I think the stock is trading at around 10 times. And they were guiding that margins will improve substantially in FY26. At around this 104, 105 mark, do you think it's well priced or you would still wait by?
I think their margin guidance for FY26 is about 18 to 20%.
Yes.
We are at about 18%. And for FY26, I think they should be at about 15, 16%. So no doubt, I think on the margin side, after the merger fallout, the kind of work they have done on the cost optimization bit is really commendable. And at 18%, I think with a EPS of about 11 and a PE of about, 10 times, it appears to be in the attractive zone. But honestly speaking, after the fallout, what has happened is that there is a lot of derating that has happened on the broadcasting space. So for us to turn constructive, we'll just not look at valuations. We think that once the ad environment improves, because again in 1Q you will have IPL and the ad dollars will shift to sports category. So there could be some delay in the ad environment recovery, and we will ideally wait for that rather than chasing the price and valuations at these levels.
Got that. Jinesh, the other big story came out of Karnataka, where they're talking about capping movie ticket prices at 200 rupees, including multiplexes. So that's got everyone concerned. What is the impact on PVR Inox if this takes place? I mean, how much does Karnataka contribute? If it's capped at 200 rupees, what could be the EPS impact?
Sure. Karnataka for them is about 12% of their overall screen mix. They have about 215 screens in Karnataka. And I think the order and in fact, it's not an order. They have just made a suggestion in the assembly that they want to cap the prices. But ideally in South, we have seen multiple states operate in the cap regime. And what one also needs to understand is that whether these caps will be there on weekends, whether it will be applicable to the premium formats or not, because cinema is basically a weekend business. So if the caps are not there on weekend, I think they are relatively better off. So I think and also one has to look at whether the order gets passed or not, because again, this situation arose in 2018. The order was passed, but PVR went into High Court. The order came in their favor, and they got certain exceptions when it came to premium formats. So it will be slightly premature to kind of think that this will have a significant negative impact on PVR. I think they will be able to figure out a way definitely from this mess.
And as of now, what is the rating you have on PVR? Because there was some mild promoter buying, and I've seen that after very, very long on PVR as well. So your rating, target price on PVR, and a quick word on Sun TV. You know, it promised at one point of time they have cash in their books, they have the IPL franchise, valuations in favor, but the stock has seen a big correction from the top.
See, on PVR, we have a hold rating. Our TP is approximately 1200 odd. And what we feel is that even in this quarter, I mean, if you look at the overall box office collections, they are at about 1700 to 1800 crores so far, and we have 20 days to go for the quarter. Given no big movies lined up, I think Sikandar is lined up in last week, but the spillover will happen in April, which means that effectively the collections will be in the band of about 1700 to 1800 crores or maybe 1900 crores for the quarter. And historically, whenever this has been the box office number, PVR has struggled for profitability. So one has to look at the near-term pipeline as well. And even in 1Q, I think barring Raid and one other Hindi movie, the pipeline on the Hindi side is not that great. So I think, again, over there, we'll have to wait when the pipeline improves. Some movies like Chhawa have done exceptionally well, no doubt about that. So on the pipeline side, once the improvement comes through, I think definitely a company with about 50% screen market share will benefit meaningfully if you have 2 quarters of good movie lineup. But that is where I think the problem is currently at this point in time. So we'll wait out for that. On Sun, Nigel, we don't cover it, so I will not be able to kind of give any view on that.
Dinesh, thanks so much for joining in. Let's get in a quick 9-10 calls. Sudarshan?
Consider buying Glenmark. Buy Glenmark with a stop under 1373.
And Mitesh?
Buy on LIC Housing for targets of 550.
Got that. Let's keep your eye on Infosys today. CLSA has upgraded the stock to an outperform. Their target price stands at 1978, which is a 15% upside from current level. 1, valuations are attractive at a 7-year average. 2, Q4 seasonality, the weak seasonality because wage hikes, etc., kick in, is priced in. And 3, the company, CLSA believes that there are medium-term positives. Discretionary spending has revived in BFSI retail. There were concerns that, will this entire tariff uncertainty, business confidence has been rattled, will this hurt tech spending? But at least CLSA believes that for Infosys, it's best placed to capture the discretionary spending recovery. Macquarie is the other one we're looking, Wipro is the other one we're looking at because Macquarie hosted Wipro in a non-deal roadshow in Singapore last week. And the management has said that discretionary spending pickup has continued, that Capco, their consulting arm, continues to see a pickup. In BFSI and retail, things are fine. In BFSI, it's not across the board, but there is a recovery. Wipro has reiterated its Q4 revenue guidance. They've said that margins will remain in a tight band. Excess margins will be reinvested back. They have an outperform rating on Wipro. So after last week's correction on tech, 2 bullish calls coming through on these majors.
Okay, all right. Let's focus on the big loser on the Nifty. IndusInd Bank. Abhishek joins us to fill us in. Abhishek?
RBI has given a 1-year extension to their MD up to March 26 versus 3-year that was sought by the board. Even last time, RBI has actually not given as much as extension that was sought by board. They had given 2 years versus 3 years that the board has sought. So analysts say that this means board will have to find a replacement. This may create leadership uncertainty in the interim period. But there are previous instances wherein, RBI has not been very active with respect to attending the board's call of the duration that has been given to lenders like RBL Bank, Bandhan Bank, Federal Bank as well. And this has led to negative reaction on stock prices. So weak profitability even in FY26 coupled with leadership uncertainty should keep the stock price under pressure is what IIFL Securities has mentioned. Back to you.
IndusInd Bank down 4.5% in trade. Clearly, that is weighing on the stock. The uncertainty, it's a 1-year extension, so what happens after that? Then you have to obviously look at succession. So kind of muddles the plot to an extent. The rest of the market, actually, even on the IT, those positive calls that have come in from CLSA, it's not really helped stocks too much. Reliance is also a little quiet. So it's a bit of a quiet start, but it's better than what the implied open was telling us. So let's see if the bulls come in and start buying the dip. Right now, actually, it's looking good. It's just about 16 points down, 19, 20, 30 points down now. So slightly lower on the Nifty. That's how it's opened out. The mid-cap index is relatively better. There's some green on the mid-cap screen so far in the opening. almost actually 0.4% higher. The bank Nifty obviously is struggling because of the IndusInd Bank hit, but other than IndusInd Bank is actually not too bad. I mean, other banks are fine, and now there's green on the Nifty, and that's what I was saying. They expect the buyers to come in because the nature of the market seems to have changed a bit last week. The mood is different, and now that elusive buying on dips has started to play out. Now, all the key indices in positive territory, barring the bank Nifty.
Well, that's right. A few stocks in the broader markets, though, are looking good. You have IRB Infra. The toll collection was up by close to around 18%. That stock's flying away in today's trading session, so it's doing quite well, up close to around 3% on rather good volumes. The street likes that. GMR Airports, let's pull up that stock as well. They've acquired additional 10% stake in Delhi International Airport. So that one, I think there was a bit of a positive tick. It's up close to around 1%. Railtel, they won an order of around 76 crores. The street likes that. That stock has opened up well in the green as we speak. The biggest casualty, as you mentioned, was IndusInd Bank. That stock, in fact, is taking it hard on the chin. But we'll have to watch out for this mark because it opened up with a cut of around 4.5%. It's still holding out there. Let's see whether or not there's a recovery in store. A couple of other names. Let's pull up Gensol. The promoter entity went ahead and they sold some stake in the open market. They say that they want to reinvest in the business. Let's see what's the initial reaction out there. The stock is more or less flattish. They have a board meeting in the next couple of days, so we'll have to wait by to hear what are they going to do with their money and how they're going to infuse that in. So that stock, is more or less flattish. Bodal Chemicals, that's one of the big gainers. It's up close to around 10%. I think we need to check in further detail what's going on here. But that stock is one of the top gainers in today's trading session. Big up move. But Rima, I think the positive this morning is the breadth of the market. You have 3.5 stocks that are advancing for one stock that's declining. By the end of today, if you can have a breadth, something like that, well, portfolios will look quite good.
Indeed. Some pharma names are higher in trade. So let's pull up Lupin. That's one. And secondly, even Sun Pharma, where the company has made an acquisition, Checkpoint Therapeutics, which analysts say is a good addition to the company's specialty portfolio. So green on the screen for some of these pharma names. And add to that a Piramal Pharma, which is up nearly 1.8%. In the hospitality pack, you've got Narayana Health, which is up, again, 1.7, 1.8%. So some buying emerging. Blue Jet Healthcare is up 3% on pretty good volumes. So that's one pocket of interest. Trend, on the other hand, is a bit subdued, and I think here Kotak has reduced the target price to 5,150. So the target price cut, some EPS downgrades too coming in for Trend from Kotak Institutional Equities. Castrol, after last week's mega run, is seeing some amount of profit booking, so that's about 2.5% down. But now the benchmark indices have turned now back in the red now for but the Nifty is holding 25,500, but it's red.
So the Nifty has been in red. The turn is more on the mid-cap index because that was cruising along quite nicely, but suddenly it's negative. So it's a volatile opening, you'd have to say that. It's not a one-way street. It's quite volatile. And on Trend, I was just adding that Kotak call seems to be a little too late. Stock's already below 5,000 now, and it's gone through serious pain and correction. And that's how it's playing out for the time being. Yeah, IndusInd Bank, now the cut is almost 5%. So let's see. Again, some green on the screen. So it's really flip-flopping. It's very volatile. By the way, there's some correction in large-cap auto names as well. M&M, Bajaj Auto, even Maruti for that matter. Auto is under pressure this morning along with IndusInd Bank.
A couple of names that are doing well. OMCs, the cooling in crude oil prices, valuation in support, the marketing margins now much higher in comparison to what the sheet is working with for the next year itself. So HPCL is one stock that's up close to around 3%. Remember, the last few trading sessions, it's moved very, very swiftly and on high volume. So OMCs is the space that's celebrating that decline that we're seeing on crude oil prices as well.
Okay, let's get in Pankaj Murarka, CEO and Chief Investment Officer at Renaissance Investment Managers, on the show now. Pankaj, thank you very much for joining in and good morning. Now, the question is, we've seen early green shoots of a recovery last week. Does it extend, and what will be the nature of the recovery? We've had a slide over the last 5 to 6 months. Is it going to be a very gradual recovery? Is the bottom in place? Or is there a risk of a W-shaped recovery, which means we recover, but again, renewed selling pressure comes in at higher levels and markets trend down? How do you expect the next few months to pan out?
Hi, Rima. Morning. I wish I had an answer to all of this. Market behavior always, is an enigma. All I know is, or the assumption that we're going with is, we still believe that the broader bull market is still intact. Having said that, it's a very matured bull market because this March we finished 5 years, the bull market started and onslaught of COVID. So it's a very matured bull market, but we still firmly believe that we are very much in a bull market. The correction that we've seen over the last 5 months is more a correction in a bull market. And from a market direction perspective, our broader sense is that somewhere we are closer to a trough in terms of aggregate as far as the large cap indices or Nifty index is concerned. Probably markets will consolidate at these levels for the next few months before we make the next move up. Having said that, I still believe that if you look at last year, CY24, the Nifty index did about 9% return on a full year calendar year basis. And we still think that given that we are in the midst of a cyclical slowdown, the economy and earnings slowdown, this year Nifty 50 earnings growth is just about under 5%, probably the weakest earnings growth that we've seen in the last 5 years. I think the returns this year could be as well into single digit at the Nifty 50 index level. But I think more importantly, what we had seen was a fair degree of fear in market over the last 8 weeks and a significant unwinding across the market. The breadth of the market was very bad. I think that one-way selling across the market probably will take a pause, and from here on it will be more fundamental driven and stock specific. So there'll be a wider dispersion in the behavior and performance of stocks, I think. But I think the broad-based sell-off is done, and probably my assessment is that probably as far as the Nifty index is concerned, we have made a trough because now valuations are at about 10% discount to the last 15 years averages, which is very comforting. And more importantly, we see growth picking up in the second half of this year. So probably growth in the second half of this year will be much better than what we've seen in the last 15 months.
Okay. Hi, Pankaj. Good morning and good to see you. When there's been this debate whether or not we're going to get into a sticky territory, and some people are also calling for a bear market. Clearly, going by what you're saying, you're not in that camp. You believe at least the headline index, where we seem to be hit, making a bit of a bottom in place. Is that correct, right?
Absolutely, Nigel. I'm not in the bear market camp. I think we are very much in a bull market. The only caveat is it's a very matured bull market. At a point in last year, September, at index at 26,000, valuations were rich. We have been over the last 15 years the most expensive equity market in the world. In the most expensive equity market in the world, where valuations are rich, and when you get an economic cyclical slowdown in the economy and earnings slowdown, markets will correct. And which is what exactly we've seen in the last 5 months. Having said that, I still believe that the broader bull market very much remains in place.
Okay, let's talk about a couple of sectors then. I think you like the discretionary spends, right? And I think you were talking about last time around, we're talking about happier things. Pizza, whiskey, Jubilant Foodworks, United Spirits. Now, the hope is that rural economy comes back because of, what's happened in the budget. And because that's seen a fair bit of pain as well. How are you positioned now on the consumption theme?
So, absolutely, Nigel. With a gap of almost 4 years now, I was starting consumer as a sector. We've been underweight consumer as a sector for almost 4 years post-COVID. But we think we've reached a point. If you see the last 2 years, the PFC, the private consumption, has been growing at about 6%, which is half of the last 10 years average. The last 10 years, PFC growth has been about 11-12% and has been ahead of nominal GDP growth. The rural consumption slowdown in India we're already 2 years into a rural slowdown because the rural consumption started slowing down in June 23. But I think we've reached a stage where we are at a very low point of consumption. Most of the headwinds are behind us. And more importantly, we see some green shoots, I would say, of revival in consumption. They're still early days. But I think we're seeing those in terms of early revival in some segments or pockets of rural consumption. And more importantly, the government itself has made a pivot this year. We've seen in this budget, the last 4 years, significant part of government resources were allocated towards driving central government investments. And this time, the budget has been a more balanced budget across investments and consumption and started with a tax break. Over the weekend, the finance minister is talking about GST rate cuts, I think, which is very important because high inflation has had a really impacted consumption in the last 2 or 3 years. So probably that will be very helpful. So I think we are in an early stage of a consumer recovery. I think the recovery will gather momentum going into the second half of this year. So if on an aggregate, meaning when I look at the market, probably consumer as a sector looks probably the most promising to me across sectors within the markets. And within that, our bets are placed across both staples and discretionary. So while on discretionary, we like some of those stocks, including Jubilant Foods and United Spirits, we like staples as well because we think that staples will see recovery as well as rural consumption improves.
What are the other big portfolio calls you all are making?
So, Rima, at this point of time, the approach is slightly, meaning while that's not an approach, but the way it comes up as investors, we are bottom-up stock pickers. So, what it comes across is our portfolio is looking more contrarian. We like financials, and within that private sector financials, again, a sector which has not done well for the last 2.5 years. And some of those boring names like HDFC Bank and Kotak banks are really now our favorite ones, because we think the headwinds that these companies had over the last 2 or 3 years are behind them, and probably they will lead growth recovery going into the next 3 years. Valuations, the stocks having remained flat almost for 3 years or 4 years, valuations are far more compelling and are significantly below where these stocks have traded over the last 10 or 15 years. And so we like private sector financials along with consumption. And we continue to remain positive on IT as a sector, because we still think that despite a tail risk of recession in US, discretionary spends in US towards IT will keep increasing through the course of the year.
Any thoughts on Innocent Bank and the news flow? Because you'll analyze private sector financials across. While it's not your favorite or preferred pick, it's HDFC Bank and Kotak Mahindra Bank. But your thoughts on the developments?
Well, so we think probably HDFC Bank is in the last leg of dealing with the challenges of absorbing HDFC as a conglomerate, because it's been now 8 quarters into it. It was one of the biggest M&A that we have seen in the financial sector, even from a global standards, at $90-odd billion. And when you do such a large M&A, it does take time to digest, absorb, and integrate. HDFC Bank, to my view, has gone from being the fastest growing private sector bank of India for 20 years to being the slowest growing private sector bank of India in the last 3 years. I reckon, or we believe that probably in 3 years' time from now, it can go back to being the fastest growing private sector bank in India. And if that be the case, then apart from strong earnings growth, I think HDFC Bank's valuation, which have got derated over the last 3 years, will again will get re-rated. They might not go back to where they were, because historical growth rates will moderate going forward. But still, we see significant valuation uptake in HDFC Bank from here on.
I was actually asking on Innocent Bank.
Oh,
any thoughts?
Not really, meaning we do have thoughts, but it's not one of our preferred bets, Arima, in that sense. We don't own that. As investors, we are moderate risk investors or low risk investors, and we usually don't like banks which have significant exposure to microfinance as a space, because our experience over the years has been that every 5 years you get some very significant credit costs coming into that business. So we've stayed away from banks which have significant exposure to microfinance.
Pankaj, hi, morning, Surabhi here. So I guess the big issue with the street is buying large caps is fine. Most people are saying that it's relatively safer to buy large caps, right? The issue is that should you venture into mid caps at all? And if yes, which are the pockets that are looking, well, relatively safe, where there's some growth, where valuations have cooled off as well? I mean, what's your thought? The whole large cap versus SMID debate. And what would you buy in SMIDs after this correction?
So I think one should definitely invest into mid and small cap, but I think at the index level, I still think that this year the large cap, unlike the last 2 years, 2023 and 24, the mid and small cap index outperformed the large cap index. Probably this year could be a year where the large cap indices outperform the mid and small cap index. Having said that, it's not that mid caps or small caps will not make money. The only point I'm trying to make is that unlike last 2 years where every stock in mid and small cap made money, from here on it will get more stock specific. So the dispersion within the index or within the group of mid and small cap will increase very significantly. So one will have to be very careful in terms of picking the right stocks. And when it comes to mid and small caps, because these are companies which are mid-size or small size, those sector approach doesn't work as much, because you have to get the business model and the management right. So bottom-up stocking plays a more important role. Having said that, we still like, meaning some of the companies I mentioned, like Jubilant, we are betting on revival and discretionary consumption. So Jubilant Foods is a classical mid-cap, and a caveat, we own that in our portfolio, so we like that. Likewise, we like some of the other names on the discretionary consumption side, because I still believe that we'll see a recovery in discretionary consumption over the rest of the year as well. The CRAMS story looks still pretty promising. Most of the CRAMS companies in India in the healthcare space are still mid-caps. We don't have a large. I think probably in 10 years' time, we'll have a company from the space which will be large cap. DVs is there, but I think there'll be more companies which will emerge, because the opportunity size out there is very significant. So some of these mid-cap CRAMS companies look very promising.
Okay, fair enough. Yeah, I mean, intrinsically, I'm sure big opportunities over there. It's just that it's a very, very complex and confusing landscape with so much of tariff talk. But take your point. Thank you, Pankaj, very much for joining in. and giving us some perspective on the market. The market, by the way, which continues to be fairly volatile. It's flip-flopping between red and green, but there is plenty of green also on the screen, so that's the good news. Nifty is up 30 points, so not bad at all. The first dip has indeed been bought. But now we're coming back to that central issue of US tariffs and what that is going to mean for Indian companies. Like we told you just a while back over the weekend, again, we had very, very sharp statements coming in from Mr. Donald Trump saying that it's impossible to sell anything here in India. And then we had the US Commerce Secretary saying that everyone must make in America. It doesn't matter how much is the cost, whether you get robots to do it or humans to do it, but make in America. Don't ship things into the US. Where does that leave companies that have reasonably high exposure to the US market? Well, we're putting the spotlight on one such company. Right now, I'm talking about Vinati Organics. Now, interestingly, Vinati has decided to set up a wholly owned subsidiary in the US. To talk about this and more, we have with us Vinati Saraf Mutreja, Managing Director at Vinati. So, Vinati, great to have you, with us. You tell us, is it just a coincidence? Were you always planning a US subsidiary all along? Or is it sort of a bit of a response and maybe a need of the hour, given the new dispensation, given what the new US administration wants? Tell us more about the US plans. I think out of your total exports, US is almost 36%. Out of your total revenue, correct me if I'm wrong, but US contributes 20%. So that's pretty significant.
Sure. Good morning. So I think like you rightly pointed out, it is actually just a coincidence. We always needed to have a subsidiary in the US simply given because it's such a large market for us and we do export a fair bit to the US. A lot of our customers want us to have a warehouse in the country itself, so it's easier to distribute products. As far as the tariffs are concerned, I don't think as of now it affects us too much. It only affects us in products where there is local manufacturing. But if you look at our top two products, for example, IBB or ATBS, there are no manufacturers in the United States for those products. It's manufactured in China and China has a tariff already. So anyways, for the last 4 or 5 years, we've had an advantage supplying to the US. And I do believe going forward, that advantage will sustain for these products at least.
Vinati, just tell us how the dynamics were working till now for the business. For your exports to the US, which is 20% of revenue, what was the kind of duty that was involved? I mean, just explain the dynamics. How was it working up until now? And now, how much of that business is going to move through this wholly owned subsidiary, which then, it becomes absolutely tariff-free, in the sense it's tariff agnostic, fully protected then?
No, I don't think, first of all, I don't think the subsidiary becomes tariff agnostic because there is going to be transfer pricing involved. So the subsidiary is not a way to avoid tariffs. I don't think that is possible, and that is not the intention also. The subsidiary is simply there to better service our customers in terms of distribution and having a local warehouse. And maybe if we want to do some sort of product customization or small synthesis, if at all in the future needed. It does not circumvent the tariffs in any way.
Means you're still exposed, Vinati. That's an important clarification. You're right. I mean, then that means there will be transfer pricing at play. So what is the blended tariff right now that's applied to, the products that you're selling into the US markets?
So it depends on products. It's a basic custom duties that they impose on products, maybe 7%, 7.5%. That's what it is as of now.
Okay, so the US, you're not going to manufacturing the US. You never were manufacturing, and even with this new subsidiary, it's only going to be warehousing and maybe some customization. No manufacturing takes place out of US, right?
Absolutely, correct. That's right.
Okay, now the US has increased tariffs on imports from China by 10%. Does that change the dynamics for you in your business line?
Well, it should make us competitive by 10%. So let's see. And honestly, this quarter is looking good. The next year is looking good. I'm not sure how much of this is because of tariffs. It could be just a general market situation. It could be just in general, our expansions are coming on stream. And please realize we are into niche chemicals, specialty chemicals, where we are market leaders and there are few competitors. So a lot of these tariffs don't have a real effect on our products.
So just clarifying that blended number, Vinati, that you shared right now, blended imports into the US, that's your products. The blended tariff is about 7.5%, right?
That's right.
And you would know how the supply chains work. So since it's all about reciprocal tariff, what they're saying is that we will tax you as much as you are taxing us. I don't even know if you're importing. I mean, what would the reciprocal rate be with India? Is there any threat to that 7.5% moving, higher?
I get, maybe we do buy most of our raw materials domestically. Again, domestic suppliers also price it on import parity. So if there is an additional duty, I'm sure the domestic suppliers will take advantage of that and pass it on. But we also import a lot from Korea, from China, from other countries besides US. So on the whole, I am not worried about this tariff situation, at least in my business, whether it's from the supply side or the sales side.
That's good to hear then, Vinati, but you're sounding quite optimistic about Q4's numbers as well as on FY26 prospects. So that clearly means that on ground you have seen some kind of pricing improvement as well as you believe that demand will be fairly firm. Give us, without getting into numbers, for Q4, if you compare it with Q3, how has pricing improved? If you could quantify it, and demand strong?
Sure. So pricing remains stable. We have long-term contracts, formula-based pricing, where we pass on the raw material increase or decrease to our customers. But the demand is looking strong, especially for ATBS. Again, coming to antioxidants, the new products, the demand in India is growing, is growing quite a bit. Butyl phenols, we are running at 70-80% capacity utilization. My new plant is very much ready and the product is getting approved for the other specialty products which goes into polymers. So on the whole, our product portfolio is increasing, our product mix is changing, and that is where the optimism is really coming from. My new plant for ATBS as well is about to get commissioned and get ready, where we're already oversold.
Okay, all right. Then now let's get to numbers. Tell us, FY25, we let it skip because, you would be in that silent period. But on whatever you deliver in FY25, given the kind of demand you've seen, given the fact that pricing could have bottomed out and you have expansions coming on stream, what kind of revenue growth are you working with? What kind of profitability margins?
Sure. I think one can expect about 20%, maybe 15 to 20% revenue as well as EBITDA growth in the next 2 years, 2 to 3 years, year on year.
And in the past, you've spoken about 26 to 20% EBITDA margins on a sustainable basis.
26%, yes. 26, 27% EBITDA margins. That's right.
Okay. And all your capacity expansion, is it on track?
So far, yes. So far, so good. Fingers crossed. Yes.
Okay. And what about competitive pressures? Investors are a bit concerned on if competitive intensity is picking up.
If the demand is growing, then we are all, taken care of. I'm not worried about competition. Yes, we do face competition from China in antioxidants. That is one product which is being dumped into the country simply because the demand in India is growing. And we have applied for some sort of relief from the government, but let's see if that happens, does not happen. That's the one product where we do see competitive threat, yes.
Vinati, I'm glad you brought this up because I wanted to actually come to the whole China angle as well. It's all globally linked, right? So you're saying on one end, on antioxidants, there is some dumping happening. So the industry is asking for what, a safeguard duty of sorts? What is the kind of tariff protection that you're seeking?
Yeah, we have requested for an anti-dumping duty.
And what level would be suitable or required, to give adequate protection?
Could be anywhere, 20% in that range, give or take.
Okay, 20% anti-dumping duty for antioxidants which are coming in from China. Just to come to the...
It's still under process. It's still under process and, it will take
discussions,
some time.
Absolutely. Yeah.
What's been the feedback from the government on this anti-dumping duty proposal or request from yours?
No feedback. No feedback yet. We have applied and we are just waiting for them to review and take their decision.
Okay. All right. Vinati, just leading into our next conversation, we've got a fair idea about your business. What about global freight rates? How have they moved? If you could give us for your business, just some color.
Well, so freights have come down in the last couple of months. And again, we pass that on as well to our customers. So whether it is raw material fluctuation, freight rate fluctuation, it really, we are agnostic to that volatility.
Okay, Vinati, always good to speak to you. Thanks a lot for joining in, giving us sense in terms of your business. And since we have ended that on the freight situation, I'll tell you what, we'll slip into a short break. On the other side, we'll focus on GE shipping. That's the next management on our radar. But as we slip into a break, here's a quick note for our viewers. The conversation around gender parity and closing the gender gap is evolving, and so are solutions. HSBC presents CNBC-TV18 Future Female Forward Mega Summit, co-presented by Cognizant, where industry pioneers share their take on what's next. Tune in to the discussions that drive the real change today at 5:30 p.m. onwards.
Welcome back. So we've got some green above our heads, as you can see, and we are pretty pleased with that. Like Nigel said, we just ended that last conversation with Vinati Organics to talk about, what's happening in terms of global freight. So let's actually get a deeper dive into it. How is the shipping sector coping with all of this tariff talk and the fact that crude oil prices are sort of reducing? This geopolitics as well. We woke up to the fact that there are new threats to Mr. Putin with respect to sanctions from the US if there's no agreement on Ukraine. So it's really, everything is happening over here. So what does it all boil down to in terms of charter rates, whether it's tankers, whether it's bulk carriers, and what's happening in the shipping market? How's demand supply? Let's ask Mr. G. Shivakumar, Executive Director and CFO at GE Shipping. Mr. Shivakumar, you're already smiling, I think. It's complex. It's a complex world, right, that you folks are navigating because there's way too much going on. So I just want to start with the basics first. Has there been over Q3 so far into Q4, has there been some stability or any hint of a recovery when it comes to basic rates? Just tell us how they've moved. I think, crude carriers were at about $30,000. That's the last figure we had. Is there any upward momentum at all now that Donald Trump is saying drill, baby, drill?
Morning, Surbi. Yeah, I think it's a little early to expect an impact from those statements. Eventually, hopefully, it will result in more export cargo of oil coming out of the US. For now, there's no impact yet. Again, it's probably a function of the oil price, and maybe they need a higher oil price to be motivated to drill more and produce more oil. For now, there's not much change in rates between the previous quarter and this one. Maybe marginally lower on average across all tankers. Bulk carriers are a little lower again, but bulk carriers is more of a seasonality. Typically, the first quarter of the calendar year tends to be the weakest quarter. So it's been weaker than the previous quarter.
Can you share some numbers, sir? So if you're saying tankers slightly lower, then how much lower than 30,000? And where are bulk carrier rates now? Some rough range to help us?
So crude tankers are more or less where they were in the previous quarter, not very different. Product tankers are probably marginally lower. Bulk carriers are also a few, maybe $3,000 to $4,000 lower on average. Again, the big ships are much lower than they were in the previous quarter, the Cape-size bulkers. The smaller ships, maybe $3,000 a day lower. In the tankers, the product tankers, maybe a couple of $1,000 here.
Got that. So slightly lower, quarter on quarter.
But year on year, they are much lower.
Year on year, what would be the decline?
So we're talking $10,000 to $15,000 a day on tankers, maybe $5,000 a day on average for bulk carriers.
Got that. Important numbers. So wanted to get your views in on another proposal that's come out of US President Donald Trump about imposing fees on Chinese-built vessels entering US ports. And that's raised concerns about higher shipping costs, inflation. Now, considering that China dominates global shipbuilding, how do you expect this to play out?
So again, this is as it stands, this is a proposal, as you said, Rima. And it's going to go through a process. I think they've invited comments, and it's going to go through a process of public hearings, which will happen in the next couple of weeks. So we'll wait to see how finally it pans out. It looks like something that will be tough to implement. It's something, if it is actually implemented, I suppose it will result in significantly higher costs of freight going into the US, because as you said, there are a lot of Chinese-built ships there. Even if they, ship owners divert their Chinese-built ships elsewhere to save on these costs, it just means that the whole supply chain becomes less efficient. Less efficient shipping means tighter markets, higher costs. So net, this is one of those things that could potentially result in higher freight costs.
Okay, potentially. But just, we know China dominates shipbuilding, but to what extent are we talking about? Do we have any numbers?
On the current order book, I think they have a majority. They probably have 60%. The order book is mainly between China, Japan, and Korea. Okay. They have the majority. I think they have almost as much as Japan and Korea put together of the current ships under construction. So they have a very, very significant majority. Yeah.
So it'll be a significant impact. And I know now it's a proposal, but do we know what's the extent of fees that the proposal entails?
Yeah, it goes up to $1.5 million per ship per port call as it stands, and which is a very big number really, which is proposed. And the enforcement is going to be tough because it depends on several factors, including how many Chinese ships the company owns, how many ships Chinese ships the company has on order. It's a complicated thing.
Indeed. But do we have any, have you all thought of any kind of contingency, any plan B in case it gets implemented in any form and shape? May not be $1 million, $1.5 million in terms of fees. But what is the thought process on how will the company navigate this headwind?
So a pretty small portion of our fleet is actually Chinese built. Most of our ships are built Japan and Korea. So we only have 5 Chinese built vessels really. So it's not, all you can do is to avoid putting them into that trade, because then it just becomes more expensive. So we'll just have to, if it comes through, we'll have to see how to trade those ships. And as I said, as soon as you introduce this new condition into the trading patterns, everything becomes less efficient, which means that, just ships make more money when things become less efficient.
All right. Hi, Mr. Shivkumar. Good to see you. And as always, the last time we chatted, we were talking about ship pricing going down by, I think, 15% or thereabouts. But at that point of time, you said it's not yet attractive. Now you have a clean balance sheet. How do you navigate things? At what time do you decide that it's time now? You need to put that cash into works and, in fact, buy some ships. That time has not yet come?
Morning, Nigel. Yeah, the time has not yet come. The prices are where they were when we last met a month and a half ago. Not very different. So we are not yet there to buy. And of course, now every day you have some added uncertainty around US tariffs, trade, etc. So I think it makes sense to wait for a bit.
On the point of US tariffs, Mr. Shivakumar, common sense would say that it should not really impact maybe shipping rates too much, right? It's a question of how much more tariff you have to pay. But then, yeah, it's still negotiations, so it perhaps delays shipments. Maybe you start doing trade with different trade partners, and that starts impacting routes and lines, and then therefore overall freight rates. I think second order, third order impact could be there. But you're best placed to tell us what is happening right now in the seas, and what do you see ahead next couple of months?
So we saw this play out in a small way in the last term of President Trump, where there were some China tariffs put there, and China put some tariffs on US products, which they've already done, where they put some tariffs on US grain. And US is a significant exporter of soybean to China. So when those tariffs came in, basically the trades rerouted. China imported from Brazil, Argentina instead of the US, and US, instead of exporting to China, exported elsewhere. What happens is that it makes the trade just a little bit less efficient. And therefore, if anything, it's got a positive impact on the market, as you said. The concern is if there are widespread tariffs, then it actually affects economic growth and underlying demand for the commodity, in which case that becomes a negative. On a ton-mile trading pattern basis, it's good for shipping. But if it affects demand for commodities, then that's bad for shipping because of general economic impact.
So as of now, it's net neutral, right?
It's neutral for now because there are no tariffs on oil, and the tariffs keep coming on and off on Canadian and Mexican oil, which is a big trade. And if Mexican or Canadian oil can't go to the US, then they have to go much further afield, which is good for tankers in general. So, but those have been kept in abeyance till the beginning of April. We'll see then what happens to that oil and those tariffs.
Thank you, Mr. Shivakumar, for joining in. It's an uncertain terrain that everyone's navigating right now. By the way, look at the markets go. After a flat opening, it's picked up. The Nifty is now heading towards 22,650, 90 points up on the Nifty. Sensex up close to about 300 points. So continuing with the recovery from last week. Mid-caps holding up in the green. Banks is still on the flatter side, but green tick. But it's PSUs dominating trade today. The Nifty CPSC index is nearly up 1.6%, and metals are adding on to the 8% up move from last week. It's added another 1% early in the morning, this Monday morning. So metals are higher in trade. Power Grid, Bajaj Finance, Adani Ports, BEL, Bajaj Finserv are some of the big movers. But let's talk about the real estate picture. Now, Mumbai has recorded over 11,500 property sale registrations in the month of February. Bowman Rustam Irani, Chairman and Managing Director at Keystone Realtors, is now with us on the show. Thank you very much for joining in. So the numbers from Knight Frank continue to point to a very robust and resilient Mumbai market. But I think that my first question is, are we seeing any kind of impact on account of the decline in the stock market prices, the negative wealth effect that we say? Is that hurting maybe the luxury apartments, maybe something that someone was comfortable buying at 30 crore would say that, well, I've lost so much in the markets now, let me go out there and buy a 20 crore flat now. So the premium, ultra high luxury kind of apartments, has there been an impact of the negative wealth effect?
Good morning, and thank you for having me on your show. Look, I've been fielded this question plenty of times before, and I'd like to just state that the numbers do not point towards what you are saying is a possible outcome of the stock market being brittle or coming down. We've seen 11,820 registrations, value of about 918 crores for the stamp duty that we see that is collected by the state. And this is just a tad down from 994 crores collected in January. But we must remember that February had less days, and this February particularly had 2 days lesser in terms of the working time given to the market. So if I was just to extrapolate, we would have crossed 12,700 odd registrations for the month, and the collections would have been way in excess of even January. So while there is a general feel that the stock market will continue to, loom and bring down the sales numbers of real estate, I do not see that happening as of right now. As a matter of fact, the homes that we see selling at max even today are those that are priced at about 5 crore rupees in the Mumbai landscape itself. And we are seeing a healthy and robust sales so far. I just spoke to my sales head for the month of March. In the last few days, we've seen a good uptake. People are looking at or are looking for new launches taking place, and there's always a buy-in over there because people look at the best price available when a new launch comes into play. So overall, the markets seem good and seem counterintuitive to what you've been saying that could happen.
What about pricing? Because we've seen a consistent, steady price increase over the last couple of years. Has that trend continued? What's been the pricing like in the month of January and February, and the expectation for calendar year 2025?
So again, the pricing, there has been no, we believe that it's better to have a robust growth in velocity rather than just the prices. And developers, especially in the mature markets, have understood that. The reports that you will be talking about lead towards, about a 6% growth in prices in the last year, in the entire last gone by. This is in Mumbai specifically. In Thane, the numbers are slightly more higher. And then when we look at the country as a whole landscape, or Maharashtra as a whole landscape, we've seen prices appreciate by as much as 11 to 14%. But Mumbai and MMR generally are a little more toned down. Between 6 and 9% is where we see the prices going. I do not think we should aim for higher prices. I think we should continue keeping prices in check so that people are able to continue affording the home of their choice, and there is a home for all, which is exactly what we've been working towards.
So that's 6 to 9% price appreciation. That is to be expected. Are you talking about the next 12 months or so in Mumbai MMR?
I actually always speak about the data, so it's past.
This is the past trend. I thought that's a projection that you were giving. So let me ask you for the projection then. In the past, Mumbai has seen about 6 to 9%, but now with the markets and the sentiment, etc., what do you see ahead for pricing in Mumbai MMR?
I would like to just give you some more data, if that's okay with you. The general acceptable or healthy overhang of inventory should be at about 24 months, okay? When the market prices start appreciating, this is because this overhang is less than 24 months. And as of right now, data shows that we've got about 18 months of overhang in terms of unsold stock in Mumbai and MMR. So this does lead to some kind of speculation of price increases, but fortunately these price increases are kind of kept to very micro markets. So certain very small micro markets might see a bigger spike, but on the larger base, I'm hoping at least that prices do not kind of escalate beyond the 6, 7, 8%. That is the inflationary trend that we see.
Baman, even the customers will be hoping that it doesn't escalate, because you're seeing demand is solid. They'll be saying prices hopefully doesn't get too expensive. But tell us, what about the affordable market? You're not leaning too much towards that, but as an industry, there seems to be some pain out there. Would you agree?
I would agree with you entirely. The affordable market is not being addressed the way it should be addressed at this moment in time, and we've said this before. There are no margins, especially in the affordable space, where developers would find it, incentivizing enough to be able to go ahead and address this market as such. So overall, we would like for a few changes that the government, we've been reaching out to time and again, and asking for certain softs for not developers but for the purchasers. And if those come through, then we are hopeful that the affordable market will be something that's great. But one of the key things that we've been asking is this 45 lakh cap that has been put as the tag price for an affordable home has been put in 2017. And if you just take normal inflationary trends, Nigel, that should be in the region of about 80 lakhs plus as of right now. So an affordable home should be tagged ideally only on the size of the apartment and not on the price point of the apartment. And even if it's a price point, there should be a distinguishing between tier 1, tier 2 cities and the rest. But I'm happy to state that in the rest of the country, and we've just come back from a CREDAI New India Summit, which is where we address the emerging markets, because that's where India is really growing as of right now. The Viksit Bharat is really happening. My conversations with most of the developers out there, they saw a good and healthy growth in infrastructure in their areas, leading to an additional buying or a greater buying taking place out there. Again, I do not have an answer for affordable housing there, but affordable housing definitely needs to be addressed by the government first, and then at the same point of time by the developers too.
For Mumbai, Bhavan, I don't know. Affordable housing would be described as what, 3 crores of late? I'm not sure. It's one of those markets, right?
I can tell you what we need to do. We need to be able to kind of improve transportation timelines. So we've just launched a project which is in Dombivli, and I can say this, that the demand has been pretty good. The buying enthusiasm has been high because Dombivli, Thane are a distance which is about 35-40 minutes, and Thane is seeing a lot of growth in their commercial development. So people who live in Dombivli can go to work in Bhiwandi, can come to Thane, and that is why Bhiwandi is a new and upcoming area. Connectivity is improving. If we increase or improve the connectivity between the suburbs and the city, or the places of commercial development move towards these places, you will see a good and healthy growth out there. Let me just give you a price point. and that would be in the region of about 75 to 80 lakhs. You can afford to get a proper home in the Dombivli market. Even today, Virar sells a one-bedroom at about less than 50 lakhs and a two-bedroom at about 75 lakhs. So it is possible to address these markets, provided the transportation or the infrastructure that we are seeing or we see happening can just be speeded up and happen quicker.
Last mile connectivity is still a bit of a problem, but thank you very much for joining in. Let's get to the markets and get in a few technical ideas as the markets are racing away higher. 0.5% up now on the indices. Mitesh is now with us. Mitesh, good morning so far.
Very good morning, Rima. In fact, the Nifty aided by, I think, if you look at the stock price movements, it's Reliance, which has done well on Friday as well, some FMCG names and the Adani Group stocks. So I have buy calls from there. On the Adani Group, I think, Ambuja is something which has caught my eye. So Ambuja Cement is a buy. Keep a stop below 490 for half year and look for a target of around 540 on the upside. And Godrej Consumer is what I've chosen from the FMCG pack. I think that's a stock which I would recommend with a stop just below levels of 1,040 and look for a target of around 1,080-85.
Thank you very much for that. Get into a break. On the other side, we'll talk commodities with Manisha Gupta. Stay tuned. Welcome back. Let's shift our attention now to the commodity markets. Manisha, as promised, is with us. Manisha, what are you tracking?
Well, I'm looking at metals as a sector, and the last week was really good when you saw many of those metal prices there, but we haven't started on the same note on Monday morning right now. So when you look at the copper prices, we are off those 9-month highs. The prices have seen a decline of nearly 1% in the Asian markets right now. Well, there are various factors to watch out for, but having said that, even with this decline, copper prices still are 17% up in 2025 till now. And the markets do believe that the first quarter is going to be on the higher side there. I want to start talking about tariffs first. And that really seems to be adding a lot of uncertainty into the markets. But it is the U.S. non-farm payroll data that the street is also reacting to. So what the markets were anticipating, you have lesser numbers than that. And that has led to a very sharp decline in the dollar index there. We're trading at a multi-month lows on dollar index. And that should have supported many of those metals. But that clearly is not the case right now. So coming to tariffs, and that really is the moving factor right now, rather the uncertainty therein. The Trump's shifting trade policies have given a rise to uncertainty in case of economic growth, and that has led to a lot of arbitrage opportunities in the international markets as well. So at this point in time, we have U.S. suggesting that they have eased some tariffs when it comes to Mexico and Canada, and then the U.S. also has ordered investigation into potential tariffs in copper imports. It takes, we are told, nearly a month by the time you will have those reports coming in. It already is 2 weeks down, so the next 2 weeks really are going to be important when it comes to copper there. If you look at the U.S. markets, well, U.S. imports 45% of its copper requirement. So whatever tariffs and what all tariffs we see is going to be important to understand. And copper, remember, is very important when it comes to EV, AI, electrification, data centers, and the conventional uses for copper also continue to be quite strong there. Well, apart from that, you have to take a look at China as well, where we have seen producers now sell to lock in profits. Is the reason that after very strong gains that we saw in copper, there is some profit-taking opportunity as well arising right now. The Chinese consumer prices also declined for the first time in 13 months. China trade data for the month of Jan and Feb also hasn't been so strong. We've seen imports decline, exports lose momentum. And as far as the US and China trade deficit goes, well, we have seen that surplus grow with US in the markets there. So it's various factors really that the street will be watching out for right now. The copper demand in the meanwhile, as I told you, has been on the stronger side. We are looking at copper deficit stories for the next couple of years in sense of anticipation there. That would support copper prices going forward. When you look at the Chinese markets, though, we have seen a lot of tangible commodity buying continue in case of China. So copper inventories are high in China.
But when you look at the US markets and LME, the copper inventories there have continued to decline. And more importantly, with the way the tariffs are going and because US doesn't have enough copper, the US copper prices are trading at a 10% premium right now to LME. So that tells you the story. And this vagary or this disruption in sense of prices is something that the markets are anticipating to continue for the next quarter as well.
Thank you very much for that. Let's talk about some stocks. Lupin, positive news there. Vinny joins in.
Hi, Rima. Yes, we are keeping an eye out on Lupin. A bit muted in trade, though opened up much higher. Now holding on to gains of almost 0.3% in today's trading session. Lupin has announced the launch of a generic Rivaroxaban, which is a 2.5 mg tablet, which they will be using mainly. And this is an at-risk launch that they've had coming in for the company. So on the back of this, Citi has given a brokerage note buy rating, target price of 2,260 rupees per share. The patent is going to be expiring in 2039. So it's going to be important to watch out for where the litigation actually goes. Currently, a litigation is going on, but yes, they managed to see a launch coming in, that approval coming in from the US FDA, and that is why that launch. Now, according to Citi, this is a $446 million market, may contribute to around $7 to $10 million per quarter initially for the two players that are there. One is going to be Lupin. Sun Pharma is also in the process of this as well, so we'll watch out for competition coming in from Sun Pharma. Nomura too on Lupin is maintaining a buy, target price of 2,350 rupees per share. They're highlighting an estimate market size of around $125 million at a manufacturer price. Overall market size for this drug is expected to be around $2.4 billion, including other strengths. Now, currently, they've only launched 2.5 mg. There are other levels also which could come out in terms of strengths for this drug. And this launch is slightly ahead of the expectation of what the street was expecting. And that is why Nomura continues to be positive on Lupin and maintaining the buy rating.
Thank you very much for that. Time for a short break. On the other side is our special segment, Market Masters. Lata will be in conversation with veteran investor Devina Mehra. Don't go anywhere.